Yeah.
Like we sat down to have lunch before, and it took us like an hour to see because everyone's coming up, they want to take pictures, they want to talk.
Yeah.
Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Dr. Adam Back, co-founder and CEO of Blockstream. We're going to talk about when cryptocurrencies will start to decouple from the trading that we're seeing in tech stocks. Dr. Back, it's great to have you with us. Welcome to Trade Talks.
Thanks for having me on.
Let's start with where we are now and how the space is viewed. Do you think the crypto market cap is a misleading metric when we think about the space?
Yeah, definitely the crypto market cap is misleading in low liquidity coins, and many of the coins are very low liquidity. The obvious example is somebody can print a Bob coin, a trillion of them, sell $1 to their friend, and now they have $1 trillion market cap with zero liquidity. And so there's a lot of approximations for that. There are 20,000 coins, most of them very low liquidity.
What happened in the Terra ecosystem, and what were the lessons that came out of that?
Yeah, I mean, Terra is a kind of algo stablecoin, so it's basically a kind of leveraged instrument, and you can think of it a bit like a bank that is a fractional reserve bank, but the way that it redeems dollars is it expands its share pool and provides people with shares equal to the value of their dollar withdrawal. And so if there's an increasing withdrawal rate at some point, the market cap of the bank falls below the dollar liability, and then it becomes obvious to everybody that it's going to collapse because there's insufficient liquidity. And so I think the lesson is that the collateral needs to be deep liquidity and independent from the success of the project, because it became a self-fulfilling prophecy at that point. Now they did have a little bit of Bitcoin, and a market sold that manually, so it wasn't actually very decentralized either, it turns out.
Yeah. Do you think this is going to affect this stablecoin ecosystem as a whole?
Well, I think it's shown people that these kind of algorithmic and sort of self-token, I mean, it shows that it's dangerous to collateralize things with tokens that depend on the confidence in a token which doesn't really have any value, right? For the wider tokens, many of the tokens like Tether and Circle and Gemini USD and so forth, they're actually fully dollar collateralized by either cash equivalents or short-term, A-rated bonds and company instruments and so on.
I think that's what's confusing for the average investor when you think about collateralizing. It's not like, okay, so I'm going to get a home equity line of credit. Well, I have my house. It's that collateral.
Right.
I have that equity already built in. And then because these are basically values placed on software for the most part, it's just hard to, I guess, conceptualize that.
Right.
And that's what makes it challenging for the average investor, or the average person to understand who's not necessarily ingrained in the digital space like this.
Right. I mean, it's particularly problematic in the case of Lunar because they were offering a very high rate of interest. And it turned out that interest was being subsidized by the success of the ecosystem itself, they were using some of the sort of bubbled value of the Lunar shares to pay people high interest. So the interest wasn't really sustainable and was effectively coming from new investors. So it's a bit of a Ponzi red flag in a way. So yeah, it's an unusual situation. I think there was a bit of confusion about stablecoins in general after that, but most of the other, normally backed stablecoins that have dollars in reserve in banks, basically, are, unaffected in terms of the safety of them.
Right. And let's talk about the decoupling of crypto from tech stocks, from the market overall. In a way, it almost adds more legitimacy to the space because you're seeing it trade with a traditional asset class. In the same token, it's not meant to be like a traditional equity or asset class.
Right.
When and what needs to happen for it to decouple?
Yeah, I mean, I think if you look at it over a longer time frame, it has sort of reacted positively as a sort of, in times of economic turmoil, gold has typically done well, and I think a lot of that interest actually flowed into Bitcoin because Bitcoin's price appreciation since the heavy start of quantitative easing in the COVID period, Bitcoin price has appreciated dramatically since then, and it's held on to the gains. Now, of course, Bitcoin is relatively volatile, but it's held on to the gains. And of course, there is leverage everywhere in people's stock portfolios where they have margin loans, and so when they get a margin call, with the cooling of the stock market, since the interest rates are being sort of crept back up briefly, I think people get margin loan calls from their broker, and they sell some Bitcoin to repay it. So that kind of thing flows through, and of course Bitcoin itself, there's a lot of leverage trading in there as well.
Right, and to my understanding, the leverage in Bitcoin and other cryptos is quite excessive, more than you'll certainly see in a stock portfolio, sometimes as high as 100 times.
Yeah, I think those are the kind of headline rates, but the average rates on those platforms are probably more in the 5 to 10 times, and of course there are lots of traders who wouldn't trade more than like 1.25 or something like that. So, but there are people who put on a lot of leverage and in both directions, and people who arbitrage that as well.
Well, perhaps, and we think about this in the equity space, we did need a valuation reset, right? Especially when you look on the equity side. You need profitability, you need revenue in order to receive these kinds of multiples. Perhaps that could have been the case in the crypto space, where over the past 2 years, the markets have only gone in one direction, and that's up. And they go up and down normally, is how markets function. So
right.
It seems like it's part of the maturing process.
Right, actually you see a little bit of a phenomena that is common in a global market when there's a bit of a financial pullback, which is as a flight to safety. So the US dollar tends to do well, even if the US has its own problems, because it's a safe haven in effect, relatively speaking, right? And you see that in the crypto space, where there's been much more of a dramatic sell-off in the altcoin sector, which has lower liquidity. Most of the people in it are not investing, they're speculating. And Bitcoin has moved more as the kind of investable asset class. So you've seen the so-called dominance index, which is the ratio of the crypto market caps that's attributed to Bitcoin versus the rest. You've seen that increase quite a bit over the last month as a pullback. So another metric for Bitcoin is the 200-week moving average, or about 4 years, and that is a metric that has never fallen in Bitcoin's price history. And so you can look at that as a kind of historic floor, and the current 200-week moving average is around $22,000. So it's, that's the kind of, if you look at it from that point of view, that's kind of dependable value, and the price gyrations above that are, the volatility, basically.
Adam, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you.